Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, January 4th, 2020. Hard to believe we're already in 2020. We're already into January, but there's a tremendous amount of news and a lot of things happening. Before I get into this week's reality check, I just want to talk about the Actionable Intelligence Alert newsletter. We started it about this will be our third year doing it. My third year doing it, I shouldn't say ours. I don't have a team, it's just me, but it's my third year. It's the beginning of the third year. And in the start of the newsletter, it really didn't do well because we were in a lot of cyclical, contrarian value type situations, beaten down industries like shipping, like gold mining, like uranium, like oil and gas. So these things were not doing well, but now it appears that things are turning around. And late last year and going into this year, things really have perked up, and a lot of our positions have been moving to the green. So I'm being cautiously optimistic. I'm not sure if this is just a bounce, but what I'm seeing across the whole commodity space, resource space, in a lot of these beaten down industries, is turns are starting to happen. And I'm wondering why that is. And I think a lot of it has to do with the conversations we've been having on these videos about the huge, I don't even want to say fire hose. It's like the opening of a dam spillway of liquidity from all these central banks. And I think we're seeing the effect of that. I'm going to get into that a little bit more into the reality check. But, when I put out my 2020 forecast thoughts, my view is that 2020, the 2020s as a decade are going to be very challenging for a lot of people. I don't see it being that positive for many reasons, which I've gotten into. We've seen the post-World War II neoliberal agenda is cracking around the world. People are moving away from globalization and more to nationalism, and all these various treaties and organizations that were created to maintain the order and the stability are cracking now. I just saw what happened at Brexit. The UK's left basically the EU. It won't be the last country. I would be surprised if the EU exists by the end of this decade. We will see fracturing of other alliances. I mean, what's the point of NATO? There's no reason for these things. So we don't have time in this video to get into it, but what I'm seeing is, I think 2020 is going to be a pretty decent year just because of the liquidity spigot that's been open. I mean, I've showed it before. The Council of Foreign Relations has a great visual that shows you central banks, whether they're overall tightening or easing. We're like almost got the accelerator to the floor. We're in a massive easing mode, and that is now starting to trickle into the real economy. We're starting to see movement in a lot of commodities, broad-based, oil, gold, copper, just about everything you want to look at now is bouncing and moving higher, and that's an indication of liquidity. Like I said, if you put enough printed money out there, you can get nominal GDP growth. It will cause price increases, will cause inflation, and you're going to get into a stagflationary environment. What I foresee happening, if you really want to pin me down, is they're not going to raise rates. We just can't do it because the debts are too high. They're not going to raise. You saw what happened at the beginning of end of last year, the beginning or the end of 2018, going into 2019. They raised rates. They went a bridge too far, and oil prices collapsed. We had almost a little bit of, I think, around 20% decline in the stock market. It was ugly. And then it immediately reversed course. We've never seen central banks. I mean, the schizophrenia at the central bank is unbelievable. Then the so-called repo crisis that has led to the Fed printing, turning on, stopping quantitative tightening and moving back into easing, the non-QE, QE, if you want to call it that. Just have couple that with the money printing that's going on with the other central banks in the world, and you just see what's happening now. So I think I've said this before, what is the catalyst? What is the thing that's going to prick the bubble because we are in a bubble. This is the massive bubble. Everything bubble is becoming apparent now. Everything is up. I mean, you have, stocks going up, bonds going up, gold going up. I mean, some of these things have inverse relationships, and we're not seeing that because we just have this flood of liquidity. But I think the thing that pricks the whole thing, and it's what we saw in 2008 that gets ignored, I think energy prices are going to go significantly higher. And I think they will be the thing that regulates this economy. They will be the thing that causes increases in inflation. Now, the Fed in the US has said that they want inflation. They're willing to let inflation run above the target rate of 2% for some period of time to play catch up. The problem is if you let inflation get away from you, it's hard to get the genie back in the bottle sometimes. You start changing people's expectations around inflation and some of the other things that happen that are psychological, which could cause them to not be able to control things as easily as they think they can. And I don't know if that happens in a year. It might take 2 years. I mean, I don't think oil's going to go to $100 a barrel this year, but I think it's going to move higher if they keep printing the money that they're printing. I mean, I don't have a chart of it, but I've seen graphs where, the biggest correlation to inflation, if you want to buy an asset class, is not gold, it's oil. So if you're seeing price increases or inflation, oil is the thing that you want to buy. And I'll get into that a little bit later into the video, but that's what I see happening, and things are starting to play out that way. And I don't think a lot of people are positioned for that. Couple that with the fact that we have stock market valuations that are near an all-time high, and a complete disconnect and inverse valuation disparity between stock prices and commodity prices. It's setting up like it might look like we might get a decent run this year in some resources. So we're positioned for that. We think it's going to happen. But we don't want to get too giddy yet. Things can change. I'm not going to comment on people talk about oil. I'll talk about it simply to say that it's going up on its own accord for several reasons that don't apply to what's going on with us. Maybe starting a war with Iran. So that could just be something that's could be an accelerant to an already price move higher. But let's get into this week's reality check. So Howard Marks, I admire him. There's also another guy I admire. You got to follow this guy at CMG Capital. His name is Steve Blumenthal. He puts out a weekly email. It's chock full of information, and he's really got some proprietary economic and market indicators that I think work very well. But in this week's email, he had this basic chart, if you will, from Howard Marks, which is a famous investor, and where Howard Marks thinks we are in the market cycle. And I will get into why that matters. If you go down to this last quote, it kind of is something that's Mr. Blumenthal put in his missive this week. It says, if you combine extreme optimism with extreme valuations, odds for successful returns are low. And that goes back to CAPE. I mean, that's, cyclically adjusted price to earnings ratios. When you have high valuations, your expected forward return is low. And this is not an opinion. These are facts. Now, that doesn't mean it's going to happen. That doesn't mean things can't get more overvalued. I think the stock market's going to have a blow-off it's going to have a blow-off run this year. And it's going to surprise people how far it goes up. But we're coming to the end of this run. The amount of misallocation of resources and the fact that the Federal Reserve is printing money and has rates where they are when the economy is supposedly doing well and we have unemployment at 50-year lows, you're running up against, you're going to have inflation. And like I said earlier, I expect energy prices to be the pin that possibly pricks the bubble. But if you combine extreme pessimism with fair valuations and the odds of success improve. Combine extreme pessimism with low valuations, and that's when the best return opportunities present. I mean, I've said this before, most of your famous investors that I've looked at that are put up there as, top notch, they made their money when they made their investment. What do I mean by that? It's this last sentence. They've combined extreme pessimism with low valuations, and that's when they get the best returns. Because why? I mean, if you're buying something that has a lot of pessimism, like shipping, for example, is something we're involved with that's moving now. There was a lot of pessimism around it. It was in a 10-year bear market. No one cared about it. It had low valuations. A lot of the companies were priced for bankruptcy. Some of them were selling at half of book or less of book value. So eventually, understanding cyclicality of the industry eventually was going to turn. Then you couple the IMO 2020 regulations and the lack of new orders and some other things, and you have a market now or a sector of the market that's rallying very strongly. And I wanted to bring this up because if you look at the general stock market and bond markets, this is kind of where we are. We're at extreme valuations. We are at in areas that we haven't really seen. I mean, would you really want to be long the U.S. stock market over the next 10 years? It's quite possible. It's possible that the market would be higher 10 years from now than it is now. But the research shows that with these current valuations, you're looking at less than an annual return of 1% over the next 10 years in the U.S. stock market. And how do you get people say, well, John, the stock market was up 30% last year. The S&P was up over 30%. And we've already started strong this year. What are you talking about? Well, that's fine, but what if you have a 50 or 60% decline in the market next year or the year after? You've just wiped out a lot of those gains. That's how you get down to an average return of 1% or less. What are you going to do? A lot of people that are in these markets, a lot of people that have the wealth, they're well past 50 years old. What's going to happen if the market does decline 50 or 60% or more? What if it goes down 30%, 40%, and you've got 10 years to retirement? People panic. People sell at the bottom. So, where are we at? Is this going to happen? When's it going to happen? Well, what I look at, and I've talked about this before in a video almost a year ago, because I thought it was going to happen then, which was I look at high yield corporate debt as my primary indicator of where the market, timing wise and the economy. Why? Okay. If the economy begins to slow down, high yield debt is known also as junk debt. These are junk bonds. Okay. These are companies that are rated triple B. Okay. And that's one level above, I think that's the lowest level that's considered investable, the lowest rating you can have that's considered investable. If you go down into the C's, most bond funds, most insurance companies, most people have a fiduciary block that keeps them from buying things that are rated less than triple B. So you have had an increase, a substantial increase in triple B issuances. A lot of it was in shale, but there's a lot of other companies. There's a lot of zombie companies. We heard that term when Japan was going through its down cycle, zombie companies. And that's what we have here. We have companies because interest rates, they've been able to issue debt, and people are hunting for yield in the bond market. Pension funds, insurance companies, retirees, people in bond funds. And they don't really know what's in these things. It's kind of reminded me of The Big Short when they were talking about how a lot of these mortgage-backed securities had a lot of garbage in them. And I think we have the same thing going on now, but in corporate debt. And I think what happens is that you have companies that are rated so low because they're barely surviving. The economy is so-called booming, if you will, but they are able to stay alive, make their interest payments so they can keep their debt rating. They don't get downgraded. What happens when the economy eventually does roll over? We are eventually going to have a recession in this country. Unless they're just going to print money and then gold goes to 10,000. I mean, eventually it's going to happen. Cash flow becomes constricted at these low-rated companies, these companies that are barely surviving. Now they start defaulting on their debt. They start getting downgraded. I've said this before. Bond funds, selling and buying bonds is not like selling and buying stocks. When you want to sell bonds, you just don't get on your iPhone when you're standing in line at Chipotle and just sell 100, sell some bonds. You have to, this is an opaque market. You have to deal with humans. They have to go out and find somebody that wants to buy them on another desk. You might have to call 2 or 3 different people. They'll get back to you. Do you want to sell them for this? This is the offer. It's not, so what I'm trying to tell you is that there's liquidity when there's a lot of liquidity, but when liquidity dries up, there could be big gaps to the downside. And we saw this back in 2008. During the last recession, these bond funds and bond prices collapsed. You could have went in at the bottom and bought bond funds or certain bonds that had 20, 30, 40% yields to maturity. And then as the Federal Reserve came in and bailed everybody out and printed money, then eventually recovered. So here you are getting, interest payments of 20 or 30% a year, because not everybody's going to go bankrupt. The world's not going to end. That's not what's going to happen. Things will recover eventually. And you have to make tremendous amounts of money. And I kind of want to show this. We thought it was happening last year. Here's what I follow. This is a fund that shorts high yield debt. So what this is showing you is that when high yield debt begins to get weak or stumble or whatever, this is last year when the Federal Reserve was raising rates and we thought the economy was going to roll over and we had the big decline. You saw that this bond fund that was short high yield rallied. Now, I was going to pull the trigger on this, but when I saw how quickly the Federal Reserve reversed course and created liquidity, what happened? This was in November and December. This is when oil dropped, from 75 to 40 or 45, when we got double clutched. And they started, tightening. They over tightened, and bonds sold off, and this short bond fund started to go up. It's inverse because you're short the bonds, and it didn't really break out though like I wanted to see it. It didn't follow through. The liquidity came, and looks what's happened. I mean, this thing's making all-time lows right now, telling you, the signal it's telling you is everything's fine in the high-yield bond market. And it will be fine until it isn't, until a catalyst comes along that creates a recession, and then these companies can't make their interest payments. And then this thing's gonna run like you wouldn't believe it. Because people will be wanting to sell those bonds and there will not be any buyers. It's not liquid. The market's not liquid. And I think 2008 was bad. This is going to be worse because we have more malinvestment. We have more companies that are zombie companies. We have more nonsense. We have more bonds being issued with no covenants. What's a covenant on a bond? Well, it says that you have to maintain, like for example, they may have as part of the debt and the bonds, the covenant, you can't pay a dividend. You can't buy back shares until you get your credit rating up. Certain things like that. A lot of bonds nowadays are what they call covenant light. You just issue the bonds and there's no covenants. Because there's such a thirst and desire for yield in the zero rate world or low interest rate world, a lot of these bonds pay 5, 6, 7, 8%. So there's a thirst for them. People buy them. Hey, the good times are going. As Chuck Prince used to say at Citibank, hey, as long as the music's playing, you got to dance, right? You got to stay on a dance floor. That's how these people look at it. They don't look at it like you and I. They're going quarter to quarter, month to month, trying to get that year-end bonus. It's not their money. They're just managing it. Of course, they have to beat the index they're being compared to. This is how you end up where, we're in so-called the greatest, best economy in 50 years with the lowest unemployment, and there's zero risk in these markets. It's all on a flood of liquidity, and it will keep going until there's a catalyst that stops it. It's like I said before, people say, well, we're going to have a recession this year. We're going to have a recession last year. What's the catalyst that's going to cause the recession? Recessions don't die on their own. They're murdered, usually by the Federal Reserve. The Federal Reserve is in easing mode now, guys. This thing's going to blow off like most people don't expect. We're going to have a blow-off run in these markets that people don't get. And the only catalyst I can see is that commodity prices rise sufficiently because they're undervalued and now money's moving in, that it pops the bubble. You got to remember something. In 2008, it wasn't just housing that collapsed. Oil was $150 a barrel. People forget that. That was the catalyst that tanked the whole thing. The other things were contributing factors also, but I mean, people forget that oil was $150 a barrel. So right now, everything's fine. It seems, until you look over the horizon. And people that can see. So I was going to pull the trigger last year on this thing. I talked about it. I have a video out there, and I didn't do it because as soon as the Federal Reserve reversed course, unprecedented reversal of course from QT to QE, and lowering rates. Well, I mean, you're going to go through another cycle then. And you saw what happened. I mean, this, like I said, this is inverse. I probably should show the high yield long, but it's the same. It's the same thing as it would be inversed. Or inverse of this chart. So this is a short. So would you buy this? This thing's in a downtrend. Would you buy this stock? It's saying right now that you don't want to be short bonds, but this thing's going to turn eventually. There's going to be a catalyst that comes along. So that's what I look at, and I'm going to put a link to this Blumenthal guy's to his where you can sign up for his weekly email. I would get it because this guy really knows what he's talking about, and he has this not proprietary, but he shows a bunch of indicators, probably about 25 of them, and they're all extremely overvalued. I mean, we are up at nosebleed levels. People are just going along like nothing's going to happen, man. Like Pompeii, people were eating and drinking, marrying, dancing, and all of a sudden one day it all ended. And this thing, when it blows up, this is going to create tremendous amounts of wealth being transferred back and forth between people, from the dumb to the smart. So this isn't happening now. What it's saying right now is, hey, everything's fine. So you got to stay long. Okay? I'm not long any S&P. I don't really invest in the normal stock market. I look for undervalued situations. I'll get into that later in the video. I still think there's places you can make money that are undervalued where the money's now going to, as sediment shifts, and money flows shift and value comes back into favor, which it looks like it is. I think we're going to do well this year in a lot of our holdings. So I just wanted to bring this up because this is what I really look at. This is what I'm looking at when people will argue and say, "Well, we're going to have a recession next year." I don't see it right now. Not until I see high yield blow up. It's the first canary in the coal mine because these companies are so weak and so stupidly managed. Most of them should go away. And as soon as the economy even turns down a little bit, their cash flow shrinks sufficiently where they can't even make their interest payments, and the jig is up. So that's just not the case right now. The ice is thick. We're not going to fall through. I haven't seen anything. As a matter of fact, this thing's making all-time lows. That's just telling you what's going on. And even right, coinciding right here, guys, with the change in monetary policy. The money's, this, like I said, this is a short bond fund, high yield funds. So you're looking for, this thing will go up when bond prices collapse and interest rates go up. But that's not even on the horizon right now. I mean, I'm going to tell you something. I mean, I made the prediction in the 2020 video. I mean, Trump's going to have a landslide victory. He is not going to be, who is going to beat him? I mean, he is not an economic genius. He runs things on a day-to-day basis, but he's cunning and savvy. I mean, we have the phase one deal with China now. Okay, we have liquidity behind him. He has the incumbent advantage. The economy for the schlubs out there in the bleacher bombs, they all think everything's wonderful. They have no clue what we're even talking about here. And people, I mean, I've seen it in my neighborhood. I live in South Texas along the border. It's one of the poorest places in the United States. Where I live is in the Harlingen Country Club. When I first moved here, it was right after the 2008 recession. There were houses on the market here. I bought my house for very cheap on a square foot basis. You couldn't build it for what I bought it for. And there were houses in this market down here that were in my neighborhood that didn't sell it took 2 or 3 years to sell them. Now houses go up on the market, it's a hot market. They don't stay on the market for a week. And people are way overpaying. My neighbor, they moved in, the other outfit moved out, they remodeled it, and they probably overpaid by a considerable amount. I was shocked what that house sold for. And we're seeing that all over the United States. And if you pump liquidity in, you can make asset markets go up. I mean, Marty Zweig said it, don't fight the Fed. But you're creating a lot of malinvestment and you create a lot of knowables of what's going to happen. And I think energy prices are going to be, people are going to be shocked how high oil goes this year, I think. I don't think it gets to 100, but, I think this thing, Trump's going to be rolling right into the election as long as he doesn't start a war with Iran. I mean, rolling in with, I don't, and then the thing's gonna roll over at some point because this nonsense won't be allowed to continue just because the prices, inflation will take off and they will have to raise rates then. And this thing comes apart. But that's that's down the line. So I wanted to bring it to your attention. You really got to watch high yield bond rates. That's the canary in the coal mine. Right now it's saying everything's fine, even though it's extremely overvalued. Do CAPE ratios work in investing? I think they do. What's CAPE ratio? I've talked about it before. It's the Shiller. Professor Shiller came up with this. It's the cyclically adjusted PE ratio. What is it? It's a methodology, which I've talked about before, which shows you industries, stocks, markets, whatever, countries that are, it's a measure to determine if things are undervalued historically or overvalued historically. The reason I'm talking about this is because two of the best performing markets around the world this year were Greece and Russia, and they are still among the most undervalued stock markets in the world, even after their recent runs. And so what CAPE tells you is that, CAPE tells us that the US market, the average yields or the average return over the next 10 years is going to be less than 1% at current valuations. Now, most people don't, when I say that, they don't believe me. They're not going to do the research. I've talked about Meb Faber. He has free white papers and books on his website that explain all this. It's been back tested. Nothing's 100%, but it's well above 50%. The solutions here. And what we see is, Greece and Russia are historically undervalued. So we would expect over the next 10 years for their average annual returns to exceed the United States. If somebody said I could put one trade on for the next 10 years and I couldn't change it until 2030, January 1st, 2030, I'd go short the US stock market and long a basket of these undervalued countries like Greece, Russia, Turkey, places like that. And people say, you're nuts. These places are basket cases. It doesn't matter. They don't stay basket cases. It's called mean reversion. We've talked about that before. That's one of the pillars of the thesis that I use is mean reversion and knowing Greece isn't going to dry up and blow away. And I learned my lesson in Cyprus when all that happened there. Cyprus is booming now. Things have recovered. Cyprus stock market went down 99%, but there were stocks in that index that did most of their business outside of Cyprus, and they got knocked down too, and they still were paying dividends during the crisis because their revenue was coming from overseas. I mean, you really have to look at things for how they are and really determine how you can make money. So this is Greece. Look, 2019, before they had the elections that got rid of the socialists and got the new democracy party in that's making reforms, you see what's happening. From a low of around 675 or up to $10. This thing's up about 40% this year. That doesn't mean it's going to keep going up year after year, but I guarantee you by the end of the decade, this will probably outperform a lot of other, and it will become overvalued at some point. Same thing with Russia. Isn't it interesting? Right around 2019, the beginning of 2019, look what happened. It's in a definite uptrend. Now, would I buy it now? It's probably a little bit overvalued, but look, you've got your moving averages moving. This is now just a trend following exercise. You just hold this thing until the 50-day crosses the 200-day. Reinvest dividends. Now, is that going to go up 1,000% in 1 year like a junior gold mining stock? No. But if you're going to outperform and get an average 12, 13, 14% returns or something like that, which is possible, average over the next 10 years, you're going to outperform the S&P. I guarantee that. And if they ever take the sanctions off Russia, the Russian economy is going to run. I mean, remember, as John McCain described it, I don't like this description, but it's semi-accurate. It's nothing but it's a gas station in the middle of a wheat field that sells, weapons out of the garage of the filling station. That's basically what it is. That's their three main industries. They're a very resource-based economy. But a lot of things are changing there. They've been forced to restructure their economy because of the sanctions. The economy's still growing. The sanctions are irrelevant now. People need their gas. You see what's happening there in Germany and Western Europe. Even Ukraine settled with them now. I mean, it's, I don't want to get too far into why Russia is a good value, but it is. And it's a lot basically on misconceptions. But it's undervalued. CAPE works if you have the patience. So I want to talk about some of the themes again. I talked about at the start of the discussion this week. Oil. I mean, look at oil. We had the big drop last year because of the Trump double clutch, and now what's happening? We're in a definite uptrend. It's probably a little bit overbought right now. We had the jump on Friday, or end of the week, because of this Iran business. Who knows where that's going to end up? I don't even have an opinion on it. It's unknowable. I don't know what the Iranians are going to do. Who knows? I don't know what Trump's going to do. Who knows? But anything that exacerbates the situation or escalates it is going to be good for oil prices. I mean, I want to throw gold up here. Look at the gold price. I mean, this is all, in my mind, attributable to the amount of liquidity that's being provided by central banks. That's all a lot of this is. It's very conceivable that I've said this before. I believe gold and oil are in new bull markets, and they're going to be probably going up over the next couple of years. Especially if this liquidity continues, this spigot of liquidity, it's not going to stop. I mean, the first time, I mean, there's still room for them to cut rates even more. They're going to do it. QE's back in effect. They're calling it repo. I don't know what they're calling it, but I just don't. QT's over with, and now they're throwing hundreds of billions of dollars back at back into the system. So these price increases all coincide with those decisions. So it's just front running it. So the other thing I want to talk about real quick, we're already 30 minutes into this, is I haven't talked a lot about uranium in the past. And uranium is a when event, not if event. I can continually chip away and add to my position. There's nothing more to be said about it. I know people are frustrated. They're selling out. People are selling out. Guys, all I can say about it is it's going to turn eventually. And when it does turn, I'll be posting it later in the week, but I had as part of the interview series, I had a guest on, Malcolm Rawlingson. People that listen to Mike Alkin would recognize he had him on. He's on Twitter also. And we talked a lot about this, and it comes back again to patience. We talked about supply, demand. We talked about the fuel cycle. We talked about energy, density. And one of the things we talk about is just patience again. You got to have patience. There's nothing else to be said about the uranium market that hasn't been said. Supply is going down. There are no new mines being developed. Demand is going up. I think I saw somewhere that almost 20 reactors, or a little over 20 reactors, are coming online. These are not rinky-dink 500 megawatt reactors. These are 1,000 megawatt plus reactors around the world, 20 of them coming online. A lot of them in China. So, and that's going to continue. We're seeing more announcements of more builds. So there's nothing really much to be said about it except for buy quality companies that are going to be around. This thing, the worm's going to turn eventually. And there's really not much more to report on or talk about. So I know people are disappointed. Well, how come you don't talk about uranium enough? What do you want me to say about it? Supply's going down, demand's going up. At some point they intersect, and the price will go up. I mean, I don't know if it's this year, next year, or the year after, but I do think the returns are going to. I mean, this is really playing out very well. We're going to be able to take a lot of the profits from a lot of the things that are turning and moving in our direction and recycle them, hopefully, back into uranium. This is really shaping up very good this year and in the following years. So, I mean, this thing's gone on now for over 30 minutes. I want to kind of bring it to a close, but I'm getting a little bit more excited. I'm feeling really good. I was really down the last couple of years because nothing that we were on was really moving too well. We had a few winners here and there, but things are really starting to turn now and come full circle to our way of thinking. So hold on for the ride because I think it's going to be a big one. And we'll just keep reporting every week and talking to you guys. Hope to see you in the comments. And please subscribe to the channel. It helps with the algorithm. We don't want you to miss any of the shows, but I definitely appreciate the support. I get a lot of great emails from you guys. I get a lot of, I get criticism too, and that's fine. I take the criticism. I like it. I like to argue with people. But there's been a lot of goodwill and a lot of people that have been following the channel for a long time. I'm not always right. I'm just a guy with an opinion. But I'm going to keep bringing it to you like I have been. So that's it for this week, guys. I appreciate it. We'll talk to you next week. Thank you.